Fusion Mobile, quality e-learning experience on the go.
You are welcome to Fusion Mobile e-learning platform. I'm Olokobi Pelumi by name, the accounting tutor, and in this class we'll be treating hire purchase contracts. And we'll be looking at the meaning of hire purchase. We'll be looking at the parties to hire purchase contracts. We'll be looking at the terminologies in hire purchase, and we'll be looking at entries in the book of both the buyer and the seller. The first thing, the meaning of hire purchase. In your elementaries, commerce or economics, you will have been told much about credit sales, whereby the owner sold goods or the seller sold goods directly to the buyer without anything being collected by the buyer. That is, goods are being sold on credit without receiving any form of cash or any form of consideration in return of the goods sold to such buyer. So when talking about hire purchase is entirely different from credit sales. It says that the seller only transfers possessions to the buyer. The seller only transfers possession to the seller in return of instrumental payment by the buyer until the final payment is made, whereby the buyer will now become the final owner of the goods. So in hire purchase, the seller usually will transfer his possession of the goods. That is, he's going to give the buyer the possession to take in responsibility of having the goods, whereby this buyer will be using the goods for a certain period of time, and in the process of using that goods, the buyer will be paying an instrumental payment, that is a fixed payment, a regular payment within a certain period of time until the final payment is being met in the contract. So until the final payment is made in the contract. So once the final payment is made in the contract, what will happen? The owner of the goods, that is the seller of the goods, which we also call the vendor, will retain the ownership of the goods, whereby the buyer will then become the owners of the goods. So the major differences between hire purchase contracts and other credit sales is that in hire purchase, the buyer of the goods only have possession, is not fully the owner of the goods, why he has not fully paid the final payment of the installment. So he only has the possession and the use of the goods. He does not have he doesn't the owner of the goods. That is not the owner of the goods. It means the seller has have the right to retain or to collect the goods within a certain period of time, which the buyer refuse to pay some certain amount of installment within a certain period of time. If he refuses to pay the installment within a certain period of time, the seller has the power to repossess his goods back from the buyer. While also in other credit sales, this buyer has both possession of the goods and also become the owner of the goods. So when talking about other credit sales, the seller cannot repossess his goods back if the buyer should default. So if there's any default in part of the or the buyer, the seller has no right to repossess the goods. So hire purchase contract having a law guiding it. Hire purchase contract is having a law guiding it. So we have the parties to the hire purchase contract. Generally, we have two major parties to hire purchase contracts. We have the seller, which also known as the vendor or hirer of the contract, and again we have the buyer, and again we have the finance company can sometimes join in the contract. So the major party is these two, the hirer and the buyer. So next thing, we have some terminologies used in hire purchase. So we can just explain some of the terminologies for better understanding of the topic. We can just explain some of the terminologies. We have hire purchase payment. So we have deposits. We have the cash price, or we can call this hire purchase price. So we have let's take cash price first. Cash price. So we have hire purchase interest. So we can thereafter take deposits. Or we can take instrumental payments. It's also term. Okay, the first term we have there is higher purchase price. The higher purchase price is the total amount that have to be paid by the buyer to the seller. That is the total amount that have to be paid by the buyer to the seller in the period. That is if the goods or the item is to be bought on higher purchase. So whenever the item is to be bought by the higher purchase, the total amount of money to be paid by the buyer is called higher purchase price, and usually that price will be higher than the normal price of the goods, higher than the normal selling price of the goods, because higher purchase interest must have been added. Now we also have the cash price. The cash price is the normal selling price of the goods. If the goods or the item is not bought on higher purchase, what will happen? We are going to buy that on cash price, which is we're going to show the normal selling price of the goods. So next one, we have higher purchase interest. So this is the interest to be paid by the buyer if he is to buy the goods on higher purchase. So it means higher purchase price will consist of the higher cash price plus higher purchase interest. So whenever an item is to be bought on higher purchase, interest will be added to the cash price to then give us the higher purchase price. So the next thing we have the deposit. It's usually for the buyer to pay some amount of the initial deposit while buying the items. So that means the buyer will be mandated by the seller to pay some initial deposit. This serves as an initial payment when the contract is to commence. So in the commencement of the payment of the contract, rather, the seller will ask the buyer to pay some initial, so some post payment. Then that serves as deposit in the contract. We call that as deposit. That serves as what? Initial payment in order to enable the contract to commence. So the next one we have is instrumental payment. This is the fixed regular payment to be made by the buyer in the contract. That serves as the fixed regular payment. So when the contract commences, what will happen? The buyer will be mandated to be paying fixed regular payment until he's able to finish the payment, to finish the higher purchase price. So once he has finished paying the higher purchase price, that is the final installment, that means he becomes the final owner of the goods. So once the goods get to this place, he just have the position of the goods. He is not the owner. He is yet not the owner until he is able to pay the final installment. So once he has paid the final installment, he becomes the owner of such items or goods. So these are the terms to be used. Where higher purchase price, which is the price of the item if the goods is to be bought on higher purchase. The cash price, this shows the normal selling price if it's not bought on higher purchase. That is the normal selling price of the goods. So we have the higher purchase interest. This is the interest to be paid by by the buyer if he is to buy the goods on higher purchase. So it means the higher purchase price is the cash price plus higher purchase interest. Now we have deposits. This is the initial payment to be made by the buyer for the higher purchase contract to commence. So we also have the instrumental payment. This is the fixed regular payment to be made by the buyer in the contract. So I think that is all about the terminologies in higher purchase. Now we can go to the entries in the book of both the buyer and the seller. So how can we enter higher purchase contract in the book of the buyer? So since we have two major parties in the contract, so the buyer has to maintain the higher purchase contract in his own book, while the seller has to maintain the higher purchase contract in his or her own book. So we are going to look at that now. So let's look at in the buyer's books. So in buyer's book, we are going to open the following account in the buyer's book. We are going to open asset account. Number 1, asset account. We are going to open number 2, vendor account, which is the IRA or IRA account. You can call it IRA. As the person is buying the account for. So this represents the creditor's account. So the next account is higher purchase. Higher purchase, interest, suspense accounts. So I'm going to open higher purchase, interest, suspense accounts. Then the next account, the last one to be open, is the profit and loss accounts. So in the book of the buyer, we have to know those accounts will be opened. The buyer is going to open the asset account, that is assets bought on hire purchase. You're going to open the vendor or the IRA account, while also you're going to open hire purchase interest suspense account. Thereafter, it's going to open P&L account, that is profit and loss account. You can also record that in the balance sheet. Balance sheet, yeah, because assets will be taken to the balance sheet, while also the vendor's account also serve as the creditor's account will be taken to the balance sheet. So balance sheet extract, how will the hire purchase appears in the balance sheet? How will this going to appear in the balance sheet? We're going to open that in the balance sheet. So we have a main account, we have 5 accounts in the book of the buyer. So let's take an illustration on that. Okay, let's take an illustration. It'll be a better understanding of the word hire purchase contract there. So we have an illustration. Sugar and Bread Limited acquired 2 lorries on hire purchase on January 1994. The total contract price is 14,400, of which 12,000 naira is the cost of the bread lorries. The hire purchase price is payable in 4 equal installments of 4,800 naira. So 4,800 times 3 will give us this. So there is no initial deposit. Record the transaction in the book of the buyer. So in the book of the buyer, we are going to have lorries account, which is the asset account. So we also are going to have vendor account or IRA account. So we're going to have IRA account. Thereafter we're going to have hire purchase interest. Okay. Lorries account will not be much like that. Hire purchase interest suspense accounts. So we have when the lorry was being bought, what is the cost of the lorry? 12,000 naira. What is the interest? The interest will be 2,000. That will be 14,000 naira 400 minus 12,000 naira. That will give us 2,400. That is the interest of the lorry. That is hire purchase interest. So the cash price is 12,000 naira. So what are we going to do? We are going to write vendor. So double entry on the acquisition of what? Of the ad lorries is to debit lorries account and credit the vendor account. We have vendor account. So 1994. We have vendor accounts. How much is that? 12,000 naira with the cost of the assets for the period. So we have January 1, 1994. So we have cash lorries account. We have lorries with the cash price of the assets 12,000 naira. That is the double entry principle. Now the next thing is to recognize what? The next thing is to recognize the hire purchase interest. So interest suspense. We credit vendor accounts with the suspense with the interest in the period with the hire purchase interest, which is 2,400. So which is also the balance of the hire purchase vendor. So and debit hire purchase interest accounts. So 1994, we had hire purchase vendor. We have vendor account. Well, we debit that with the amount of interest for the period, which is 2,400. So we then have December 31st, 1994. We have installment of how much? We have installment of 4,800. So with the payment of installments, 4,800 as of December 1994, what will happen? The buyer will have to credit his cash account and debit vendor account. So we have cash or bank with the amount of installment paid, 4,800 naira, and we are going to balance the account. Balance carry down. Balance the account. So we have that will be 14,400. So we have 14,400 minus 48,000. That one that give us 9,600. So we can then balance the account. So as at 1995, January 1, 1995, January 1995, we have balance brought down. That is New Year, which is 9,600 naira. They are mostly owing to the vendor, higher purchase vendor. So 1994, this is the amount of interest, but this is not all of the interest that will be recognized in the year. Since the higher purchase contract will be paid, will be for 3 years. All will happen, we have to apportion the interest to that number of that 3 years. So it's not all of this we are going to take our profit and loss account. So we have to divide this by 3 since installment is paid equally. So that will be 800 naira. So 800 naira will be charged as the interest to be recognized for each year. So what will happen? We have December 1994. So we have P&L accounts, and 800 naira will go to P&L account. So we have balance carried down for the period, which is 1,600. So we can have 2,400. We can then have 2,400. So in 1995, that goes to P&L. 1995, we have balance brought down. Like for January, 1,600 on the amount of interest remaining. So next year, what will happen? As of December 1995, what will happen? This is already closed. This already is the law is an asset account is closed, unless if there is depreciation on the what on the asset. So the next thing is to recognize the December 31st, 1995. What will happen? Another what installment will be paid, and if the installment is paid for that period again, what are we going to do? We are going to debit vendor account and credit what cash account with the installment to be paid for 1995. So installment of 4,000 naira will be paid. So what is the balance remaining to be paid? So we have balance carried down, which is 4,800 naira remaining to be paid. So we can balance the account. That will be 9,600. 9,600. So that's January 1, 1996. So we have balance brought down. Amount remaining to be paid to the vendor. So in the year 1995, this is the interest remaining, but it's not everything that will be charged to profit and loss account for that year. 800 naira will also be charged for that year. So we have 1995. We take it to the P&L account. So what will happen? We have 800. So we can have balance carried down, which is 800 naira. Then we can then balance the account 1,600, and then balance the account 1,600. So in the year 1996, we have balance brought down. So 800 naira. So in the year 1996, what will happen? As of December, there will be payment of what? Installments. So we are going to debit a vendor account with the amount of installment to be paid for that year also, which is 4,800 naira. So we are going to have balance carried down, which is okay. Well, that will be all. That will be the balance. That 4,800 naira. So I think that is the full payment of the installment. So once this installment is paid in 1996, what will happen? And that is all about the hire purchase contract. So in the year 1995, we take this balance of interest. In 1996, in December 1996 also, what will happen? That will be taken to do what? To the P&L account. 800 naira will be taken to the P&L account. And so that is all about the transaction. Okay, I'll just close this 800. I'll just close this 800 to make it neater. So the next account to be opened is our P&L account. The P&L account, profit and loss accounts. So as at 1994, we have interest, HP interest, hire purchase, HP interest. So how much interest was recognized at 1994? 800 naira was recognized. So P&L account will be debited with the double entry. Hire purchase interest. So 1995 also, we have HP interest. So we have 800 naira also in the P&L account. So the P&L will be debited with the amount of interest paid in the period. 1996, we have HP interest to be paid also in 1996, which is 800 naira in 1996. So that is all about the hire purchase transaction in the book of the buyer. Now the book of the seller. So in the seller's book or the vendor's book, the following accounts will have to be maintained in the vendor book or the seller's book. Number one, sales account, because that sales account will be maintained. Number two, the debtors account, which maintains the buyer's account, that is the buyer, for the buyer, is kept for the buyer. And number three, we have the hire purchase interest received account. Hire purchase interest received account. So hire purchase interest received account, and you can have the profit and loss, because you have the charges to profit and loss account. So accounting entry is just like the reverse of the hire purchase in the buyer's book. Is the reversed. So if the asset is being sold in the period, what will happen? The debtors account will be debited and sales account will be what? Credited with the cash price of the asset. And when interest is being recognized, hire purchase interest will be what? Will be credited. And what happened? Debtors account will be debited, and interest received will be what? Will be charged to each share of the what? Of assets up to what? Up to the equal life of, up to the year in which his final installment is to be paid. So each interest received in each period will be taken to the profit and loss account in each period. So in the seller's book, we don't need much of an example, since it is the reverse of the what? Of the entries in the buyer's book. So we don't need much. So in the seller's book, each of these accounts will be maintained: the sales account, debtors account, that is the buyer account, hire purchase interest received account, and also profit and loss account. So we've done a lot on hire purchase transaction. We've explained the meaning of hire purchase. We look at the parties in hire purchase transaction, that is hire purchase contract, that is the buyers and the sellers. We also talk about the terminologies in the hire purchase transaction. That is, we talk about this hire purchase price, cash price. We talk about the deposits. We also talk about the instrumental payment. We talk about the hire purchase interest. Then we also look at the hire purchase transaction in the book of the buyers and in the book of the seller. So if you have any difficulties with this topic, do not hesitate to repeat your video. And again, some exercises will be displayed on your screen. Do well to attempt such questions. Thank you.